And we are live, I think. Yes, we are. Yeah, questions are going to be coming through, Arun, and you can ask as many as you want. I'm just going to let this pile up, and then we'll be doing our thing. Hello, Kevin. Dav. Da, 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 da. If there's lag, and let me know if the audio is okay. Should be good. No pseudo fair value gap. I'm not going to go into that, but it's just like it's kind of a fair value gap, but it's kind of not. Da, da, da. Is the stream lagging? Himanshu, Aurora, no. The stream is going to be recorded, yes, but it's going to be on YouTube, not on Discord. That indicator is power of 3 exo trades. But we're not going to be using that. Okay, can we just get someone to confirm if the stream is lagging or if it's good or if the audio's messed up? Just let me know, please. It's good, thank you, Tillman. Okay, so it looks like we're going to get some time distortion going into 9:30. How do you know that? Just because, well, we have a lot of overlapping candle bodies and we're just before the open, 10 minutes away from the open. So you can expect some accumulation here probably. And that actually hints that the open's going to be a bit more volatile than usual. If you're just trading normally going into the open, versus if you're trading like this, you'll probably see more volatility. We'll come to that later. So I think we'll go through the news first. If I just get Forex Factory up. We had 8:30 medium impact. Oh, yeah, it was medium impact. If I bring it here. Okay, the news events. We had 8:30 core durable goods orders and durable goods orders. That, even though it's orange folder, you don't need to be like fearful of it stopping you out of your trades. That is usually just a little volatility injection to carry towards a stop run. So although you shouldn't be trading it, I'm not saying you should buy at the news or sell the news or whatever. But say you're positioned at 8:15 in a buy. Are you going to let this scare you out of position? No. So, yeah, don't let that scare you out of position. So we're going to look at our pre-market range. This is the first thing you always want to look at when trading the open. So pre-market low, pre-market high. The pre-market range is between 7 a.m. and 9:30 a.m. First pools of liquidity you're going to refer to is the pre-market high and the pre-market low. If you completely omit just everything before the pre-market, and we just ignore London, ignore Asia, ignore New York PM yesterday, ignore the new day opening gaps, you can trade with just the pre-market high and the pre-market low. So, am I saying let this get manipulated and then buy into that? No, but I am saying that you should treat these as low-hanging fruit objectives. We had a wick here, so that's probably something to look at in terms of the key levels. What's this black line? This is an order block. Okay, so we're going to start off on the higher time frame, and we've got this breaker block, which I highlighted in the weekly outlook. Then we've got, I'll come to this, I think that's the London range. What's the name of the indicator? Which indicator, Kevin? And then here we've got this bullish order block, so we've displaced above it. That validates it as a bullish order block. Okay, this isn't an indicator, this is, I just drew it on. Pre-market high, pre-market low. So the new day opening gaps, you want to refer to these. So I'm looking at how price is going to trade between the new day opening gaps, these two, the hourly order block, and the pre-market range. And then I also have in mind that we could trade into the London low, potentially getting optimal trade entry with Asia session going into an area of support down here, being an order block or a rally gap. If I go to a 5-minute, that'll be a bit more clear. So something like this, trading below the low of London into potentially a bounce price range and then going higher into the pre-market high. That would be our low-hanging fruit. And then ideally into the new week opening gap. This is the wrong way around. I should say low. I could take partials out of event horizon, yeah. Yeah, pre-market is 7 a.m. onwards, so you're looking from 7 a.m., that is the first pre-market hour, until 9:30. Okay, this green Fibonacci retracement here. Get rid of all this for a second. So this wick is particularly important because we have our London low over here. This candle, this 2 a.m. candle, marks our London low on the 4-hour chart. Trading below the London low is something I want to allow for today, and then potentially trading below that up into the new week opening gap. So I'm looking at these wicks as key level. This wick, the quadrants of this wick, I'm looking at that as a key level, and then we'll see if we can get a reaction off this and then go higher, or if we'll go below Asia's low and potentially use an order block of some sort. Can you explain opening gaps real quick? Yes, I am coming to that. Roll this back on. Okay, so opening range gap, you're going to come into the bottom right of your chart, and you can see here it says electronic trading hours. You want to click that, and you want to go to regular trading hours. Now, prior to 9:30, you're just going to have a chart with no price action, so nothing's going to be forming. But the candle closure at 4:14, right here, is the regular trading hours closing price, and then you'll see the regular trading hours open at 9:30, and whatever that gap is. So say the 9:30 candle opens up there, would go from the closing price of 414 up into the top quadrants. Closing price at 414 up into the 9:30 candles open. Okay, we're just going to distort into 9:30, I think. Okay, we have got 10 a.m. medium impact news, a similar situation to the 8:30 one. You don't need to be shook out of a trade because of that. I'm not going to let this dictate whether or not I get into a trade. It's more like just a little tiny volume injection. Grey bull candles. The grey candles are bearish candles, and the red ones are bullish candles. So like this, that's an up close candle. It opens here, and then it trades up with a wick, and it closes there. That's an up close candle. I can change it if you want. It's just on brand with Velric, so I like it. Okay, so once you look at the pre-market range, what else do you want to look at? You want to look at session liquidity. So we have London's high, which has been run in the pre-market, and then we have London low, which just wicked or traded into the 4-hour wick of the Asian range. You call me Velru. Velric. Okay, so if you're looking at this, we've got our new day opening gap. We're just like chilling around the new day opening gap. So we're not really getting a willingness to leave this. That's because we have the open at 9:30. So price is just going to be in time distortion when it has no real objectives to go to. Yeah, Harun is just linked to brand. It's not any easier or harder. I might just remove these actually. It might get a bit cluttered when I put on the opening range gap. Okay, so we're going to talk a little bit about opening range gaps until market opens, and then we'll select. I might just put it on a different thing. Okay, yeah, so I'll put the opening range gap on this chart, and we'll switch between thingy. So the opening range gap, you want to look at the size, and you want to look at the quadrants. That's why we use a fib. The most important levels of your opening range gap, or otherwise known as your regular trading hour gap, actually we'll just put it on the other chart because yeah. Okay, so what levels are we looking at? We're looking at the midpoint, the high, and the low. I realize that this chart looks very cluttered right now. I'm going to try my best to make it a bit easier for you to see. Get rid of this hourly order block. Midnight. And we'll put this one on later. So we have a premium opening range gap. What does that mean? It means gap is basically just above market price. So if you have other buy side objectives, you can look for this gap to get filled aligned with the idea that you're going to trade into the buy side objectives, and that is higher probability. Okay. Back. Is it unmuted now? Yeah, it's unmuted. So we've traded past the consequent encroachment of the opening range gap. We've just filled it in. So if you look at this 0.5 level, I realize there's losses there, but look at that. That is the consequent encroachment of the opening range gap. That's an important level because 70% of the time, if you get a gap that's less than 120 handles, and in this case our gap was 40 handles, you're 70% of the time going to fill that in within the first 30 minutes of trading, which you'll want to write down. Here you can see the respect on that new day opening gap. Plus we've taken out our buy side from 637. So I wouldn't consider it unreasonable now to run into our pre-market low and then potentially even London low. And what I would like to see, not what I'm saying will happen, but what I would absolutely love is if we can drop into London low and use one of these levels, which is a 4-hour wick, as support, and then trade higher back into our new week opening gap. That would be a really good long setup. You get good risk to reward ratio on that, and although it might not trade all the way into the new week opening gap, that would act as a magnet for me. I don't know what this blue line is here for. So if we're looking at yesterday's price action, we have from 12:45 to basically the end of PM session, lower highs, and they are, if you pay attention, they are very tightly bunched. It's lower high, lower high, lower high, lower high, lower high, lower high, high high, lower high, lower high, lower high, lower high, high high. So that is low resistance liquidity, because it's not going to take a lot of volatility for price to just run through all of that, because there are so many stop losses here. This is seen as support zones or resistance zones by retail traders. So everyone is feeling confident in putting their stop losses there, meaning anyone who's short here, they're looking at this as like a good place to put their stop loss. So when we eventually run on that liquidity, it's not going to take a huge move. Like, as in, it's not going to take a lot of fuel, if that makes sense. Because there's so many orders there, it's just a magnet. Okay, so we are trading lower. You could consider a 931 candle as a first presented fair value gap, depending on like how you like to measure the ranges. That's 2 handles. So I wouldn't really use this as a first presented gap. I would just use it as a gap. Like, I would just eyeball that level, keep it in mind. How to remove ETH background shade on TradingView. If you go to your settings, and in symbol, you go to electronic trading hours background, and you change this to 0. That'll work. Okay, so we've traded back into this consolidation. If you're looking for higher prices, you could consider it just to sweep this and then go up, but I think the London low is pretty good for a run higher. So when you're trading, not just in the New York Open, any time, you want to be cycling through the 1 minute, 5 minute, and the 15 minute. You're always going through these 3 time frames and you're looking for points of reference. So on a 15-minute chart, I can see PD arrays that are going to hold more weight and more significance to price action. Whereas on a 1 minute, I'm not seeing that same level of PD array. I'm seeing all these small ones, but I'm not seeing like this order block that held up price. You wouldn't see that on a 1 minute chart. So although you don't need to be trading on the 15 minute or the 5 minute, maybe you want to trade on the 1 minute, that's fine, but you still want to be looking at points of reference on your 5 and 15 minute charts. PD arrays, pools of liquidity, anything that's giving you a narrative. And when I say narrative, I don't mean, well, actually, no, I do mean just the story of what's going on. So here, who's coming into the market? Who's being tricked into the market? Sellers. Everyone's selling. Where the stop loss is going at this high. And then come the open, we have time distortion for about 30 minutes going into the open, which is more accumulation on both sides of the market. Because if people are entering positions here, where's their safe, quote unquote, safe stop loss? It's at the high over here or the pre-market high. Or in extreme circumstances, extreme circumstances, say large funds who are trading with stop losses bigger than you can imagine, they're placing their stops here. Okay, so we have wicked out this consolidation low. If you watched my swing grading live stream and you're looking at an implied range, here's your impulse price swing. And you can treat this as terminus, the pre-market high as terminus, or this as terminus. Then you get that consolidation there, you sweep out the consolidation, and you trade higher. The thing with consolidation is you'll never really have an idea of how long it's going to be for. Because for IPTA, the interbank price delivery algorithm, a little retracement, an order block, is enough, like this. That's enough to be considered consolidation. So you can never really just guess how long it's going to be for unless you're in time distortion. And that's the difference between time distortion and consolidation. Consolidation can happen at any time. Time distortion is when the algo is delaying price action going into an important time. So the market open, or a news event, like an 8:30 news event, or a macro, or the next hourly candle's opening price. So say we're just in, say 7:30, and you have nothing. You're basically waiting for macro here. Well, you get this little stop run first, so I guess that doesn't count. How's that NWOG? This is NDOG, new day opening gap, and this is new day opening gap. NWOG is up here, new week opening gap high, new week opening gap low. And that is from August 22nd, Monday. Okay, so we've still got our new day opening gap supporting price. I haven't taken the pre-market high or low off the chart, although the pre-market high has been traded through. You can still see these used as points of reference. So although I don't treat them as PD arrays in and of themselves, like a fair value gap, I know some people leave them on the chart and they take entries off them. I don't do that, but I do look at them and how is price reacting. You're not going to count that as a breaker. It is a breaker, but I'm just focused on the new day opening gap. There's probably 20 PD arrays here. Volume imbalance there. Fair value gap there, inversion fair value gap, reclaimed fair value gap, implied fair value gap. But, you wouldn't mark out every single PD array. Okay, so just had this little stop run. And when you see a stop run and then you react quickly, you want to check, did we just get an SMT? So you'll go to something like ES, something that's correlated, and yeah, we've got an SMT. Equal highs. Oh, I think it's slightly lower. No, it's equal. And YM, that was an SMT. Okay, you want to look at 940 as a very good first presented fair value gap. It's okay if price runs below this. I'm not marking this out and then saying that it's gonna, trade higher off that. I want to see how it trades around it. So if you see me mark out a PD array, like a bullish order block or a bullish fair value gap, that's not me saying price is going to respect it and then just, trade off of that. That's me looking for narrative. Like here we inverted it. Say I'm looking at the pre-market low for low hanging fruit for sell side objectives, and I'm not looking at the London low. And this is inverted. I could take a trade off that, surely, if I had that directional bias, which I don't. Brown ICT has entered the chat. I haven't checked the micro. Let's look at the micro. It's pretty similar. Yeah, I don't really trade the micro, to be honest. The reason that's my first presented fair value gap, and I know you're probably looking at the 931 candle as your first presented fair value gap. The reason I'm using 941 instead of 931 is just because this is really small compared to the candles around it. Now, you can say that relative to the range it's in, it's not bad, but if you're looking at the wick here, and then you're looking at candle here, like two handles versus, whatever this is, I would argue that the more significant fair value gap, the one that's going to have a more lasting or effect, is this one. Oh, I'm blind. We have this here as well. So this would be a fair value gap range. You don't need to treat it as a 3-candle pattern. Oh, I checked the micro. Yeah, to be honest, it's not that. Oh, wow. Yeah, you're right. Should have used the mini. So yeah, common misconception with fair value gaps is that it can only be a 3-candle thing. You can have fair value gap across multiple candles. So I would consider this entire thing a fair value gap. Let's break that down actually. Because what is a fair value gap? Why is it acting as a fair value gap? Because it's leaving pockets of unfilled buying orders. So anyone that's going long, there's not enough people going long here. This is just sellers. Everyone's selling there. So there's little pockets of voids, basically, where price hasn't been filled in. And that's not limited to 3 candles. That's limited to a range. So in this range, we just had impulsive sell-side delivery. Then there is a void of buy orders in here. So trading through that entire range is completely fine. You don't need to limit yourself to just that fair value gap. And then why am I drawing through the wick? Because we have the volume imbalance. So if you can see that little gap between the 731 candle and the 732 candle, that volume imbalance is your confirmation that you can trade, or that the gap goes through the wick, because you account for that volume imbalance. Lovely jubbly, pre-market low. So there's no not really there's not really a difference between using NQ1 and then NQU 2025. You'll find that they have the exact same price. Exact same price delivery, everything's the same on it. Okay, and then if we're looking at these wick levels for support, if you have joined a bit more recently, those wick levels are from the 4-hour 6 p.m. candle's wick. The 6 p.m. candle is always a significant candle on the day. If you have a significant wick, and then you have like London low, and then you're expecting London low to get visited, you can grade this wick and then look at it for support. So we can take London low and then look at the range between London and then Asia. It's 43 handles. So it can take London low and it might not go all the way to Asia, but it'll react off one of these levels as support if it's bullish. Plus you got this BC and this breaker block, and the breaker block low from the 1-hour candle is aligned with the 0.75 level of the wick. Trade was right, but I got taken out when it entered the first presented fair value gap. To be honest, you shouldn't have really been trading this price action, even though we kind of just walked through it. I wouldn't trade that. Is it also a volume imbalance if candle bodies overlap with each other? It is a volume imbalance, but if you backtest it, you'll find that the ones where there's a gap rather than overlapping bodies, they work way better. Just way better. So overlapping bodies, okay, here we have a gap. That one will work better than overlapping bodies like that. So I don't really use volume imbalances when there are overlapping bodies, to be honest. It's just like trash, not gonna lie. ICT does teach them as a volume imbalance, and he says that they're just the same as the other ones, but if you backtest it, to be honest, I don't like that. Then it left it and it went back lower. I don't know what you're referring to. Not sure how I could avoid that unless it took a loss and re-entered again. I had no idea it was good. I'm assuming it was a fake out and a re-entry. Yeah, fake out, take out bias, and then drop lower. Oh, sorry, take out the sellers and then drop lower. Okay, so we're entering the 950 to 1010 macro now, which I'll draw out on the chart. This macro is one of the most important macros throughout the day. This is what is known as a distribution macro. It's too cluttery on the chart. Just have it like this. Fair value gap. If you're looking for buys, you want to see this. Plus the new day opening gap. Yep, nice delivery. And now we've traded above the first presented fair value gap. And then if you look at where the first presented fair value gap is, and I'll put all those drawings back on in a second. You can see it was inverted, and then we traded above it, and then now we've reclaimed it. And then if you look at the structure of, I'll show you. Over here we've got high, low, and then higher high, which makes this a breaker block. And when you have a fair value gap forming in a breaker block, and it's in the discount of a breaker block, and then that gap gets inverted and then reclaimed, you can treat that as a Reaper fair value gap, which is just, it's a fancy name, but it's just a stronger fair value gap. And then here you can see we fell short of this midpoint, the consequent encroachment of the fair value gap at 950. And by the way, there is no significance in the fair value gap that forms at 950 versus like 952 or 953. Just because that's the minute the macro starts doesn't make this gap more significant than a fair value gap at this level, 953. Doesn't mean anything. You'll see a lot of Twitter gurus trying to tell you that it does, but it doesn't. So we fall short of the consequent encroachment of the fair value gap from 953. What does that mean? That means, well, first of all, you can treat that as an institutional order flow entry drill, especially with this balanced price range. But it shows strength. Prices are even willing to trade lower into the fair value gap, and then you get this downwards candle, but then you displace above that. That's a strong sign of buy-side delivery. Oh, sorry, buy-side bias. And then I would expect this gap to hold. It's a Wally puck. Okay, really good. As long as we close above the midpoint here, I would expect more speed. So if you watch ICT's execution videos, any of his trade executions, and he says he's willing to, he's expecting speed, it's usually when you're getting a wick, trade through a PD array, and then you close above that PD array or just slightly inside it. So if the wick had traded past the midpoint, yeah, but imagine it had traded all the way here, then I would be expecting a lot more speed. But this is enough to like expect a bigger candle, because it's hitting trading stop losses. Anyone that's trading their stop loss like a moron, really tight, it's allowing large funds to get in. Let's look at a 2-minute chart. It's really nice in 2 minutes as well, but I could see this closing down and trading above it and then making this an order block, and then using that to go higher and into SIBI from the New York PM yesterday. So you can see how price instantly, when the macro started, it started to get really algorithmic. And I always say in the Discord, avoid the open and then at least wait for the macro, read the macro, and then that's when you're going to start to see those algorithmic footprints, like this fair value gaps delivery, the delivery of this Reaper. Look how we've rejected on there. Regarding the levels of the opening range gap, I'm just going to make them bigger so it's easy to see. Okay, I'll change it back in a minute, but you're not looking at these for trades within the first 30 minutes. After the first 30 minutes, this is how I view them. I know ICT doesn't teach this, but I prefer using this after the first 30 minutes when the market opens. So I'm not looking to take trades just because it's reacted to one of the quadrants, or it's reacted to the high or the low, or the midpoint within the first 30 minutes. After 10 o'clock, yeah, you can do that. But before that, I like to just wait out this whiplash. It's rare that I'm taking trades within the first 30 minutes. Or sorry, within the first 20 minutes. I will take trade in the macro, for sure, 100%. Have we got that close candle yet? Nope. Okay, I would have liked to see this 2-minute candle close above this 956 2-minute candle, and that would be a change in state of delivery, which would validate this as an order block. But that could happen here. 10 o'clock candle. Hey. We have 46 viewers, wow. Subscribe. If I was in a trade, maybe around this order block. Would I set this to break even? No, I would want room for, I'd say, this order block to be traded into. So I would not expect, if we are bullish, I would not expect us to trade past the midpoint of this order block at 952. Up to there, it's fine. Then, like, that's all I would allow for. Going below that, I would see this as an invalidated long. So that being the order block, basically. Bullish order block. That wick there, right on the consequent encroachment level. That's pretty nice. Okay, that down close candle on a 2-minute chart, ugly, very ugly. If you're looking for buy side delivery, that isn't what you want to see, to be honest. But everything else points to buy side delivery, so, just that one little thing. You shouldn't let small things like that scare you out of a trade, but, just keep them in mind. So it's 10 o'clock. Well, it's 10:02. I hope you do more of these, they are so great. Thank you, sir. Samuel Johnson, thank you very much. Sure, I'll do more. Still struggling with stop losses. Could you please repeat again where should be my stop loss? I took the order block entry. Yeah, so because we've displaced so far away from this order block, if I just remove everything and I just focus in on this order block for you. This is your order block. This is the middle of the order block. Because we've traded away from it with displacement, If it was just a little bit, like, for example, this, we just trade above it, I wouldn't have the mean threshold of the order block as a stop loss. But here I can. Why could I feel safe in having a stop loss over there? Because for price to trade all the way down past the mean threshold of the order block, mean threshold just means the middle. It's just a fancy word for the middle. For price to trade from here, say that was there a second ago, all the way down to the order block, I would want it to go higher. I wouldn't want it to go past this, because which part of the order block is going to give you the most reaction? It's the first half. The open is the most reactive, so the high of the order block, and then the lower half is where you're going to see less, support, less bullish reactions. The first half is always the strongest bit. If you're not supported by the first half after you've gone past another bullish order block and a BISI, and you trade below here, below the mean threshold of the order block or the midpoint, you would expect that after dropping below so many PD arrays and then dropping below a significant level in the order block, that you're switching from a buy program to a sell program, and you can no longer really be confident in a buy trade. So that's the idea of having a stop loss set below the mean threshold of an order block after we've displaced away from it. Again, this isn't displacement away from the order block, and I wouldn't, if I was entered there, I wouldn't have my stop loss at the midpoint of this order block. That is not a safe stop loss. But having it over here, this to me is a safe stop loss, and I wouldn't expect price to trade down here unless the trade I'm in is wrong, unless I'm wrong. And you can be wrong. Okay, so this is a bull flag. Yeah, it's bull flag because we're accumulating above an old high. So all this little consolidation, that's accumulation above this high here, this swing high. You can fade this, but because it's a bull flag is a retail pattern, by the way, and it's like this. So retail will expect to see consolidation lower, just lower, 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 and then a move higher. You can go with that, but expect retail to get stopped out at some point. How? Price will fake a move higher, sometimes, not all the time. And then this is where, okay, we can have confidence in the bull flag going up. That's the retail mind. And they're buying, and they get stopped out, and then it goes higher anyways. So it just really screws them up. Let's put my drawings back on. There we go. And look at that reaction to the midpoint of the order block, the rebar. That's why it's important to have the knowledge that you can use this as an entire gap range, because if you had just this, you'd be getting all your levels wrong. But here you're getting the levels correct. 956 candle is an intermediate term low. 956. Yeah, it is. But I wouldn't consider it a strong one. Like I wouldn't go so far to say it's protected low. Mainly because we're accumulating here, and accumulation means there's stop losses, or there's orders being placed on both sides of the market, longs and shorts. And the closest stop loss that someone can have if they're shorting here, if they're buying here, is below this low. And because it's in such close proximity to where the accumulation is, I wouldn't be opposed to price coming just below that low and then giving you a turtle sleep entry before going higher as just one little run on stops or sweep on stops to fuel another move higher, especially after accumulating for so long. So although technically, pattern-wise, it is an intermediate term low, I wouldn't really treat it as one. That kind of knowledge comes from just experience. While drawing liquidity, do you look for a silver bullet? I look for session liquidity. You can watch my high probability target series for all the other points of liquidity that I can use. You can use new day opening gaps, new week opening gaps. You can use external range liquidity. You can use a SIBI or a BSC or an order block. Literally anything. I'm going to take this off now. It's kind of in the way. But you can see that price is showing a reluctance to drop below the midpoint of the opening range gap. Yeah, the algo is very impressive. So again, we'll jump onto the 5-minute chart, and it's very choppy. I have a video on trading choppy markets, and I say in that video, when you have a 5-minute chart that looks like this, you don't want to be in any trades. Obviously, after the macro started and that stop run before the pre-market low, then it was fine. Like after that, it was fine because we had the stop run. But say there, that's the bit you don't want to be trading. Nice. Right at the end of the macro. Okay, is my trade done? Post in Discord and like after this is done. If I was to be, well, I'm not going to tell you, but say I wanted to pick a side of the market direction right now, I would lean towards this new week opening gap being our drawn liquidity. It's 70 handles away. We can easily get 70 handles in the next 50 minutes. But I don't need it to. I've taken my profits. I feel very hydrated today because I've got electrolytes in my water. Tastes really good as well. What did I trade? I'm not showing my trades on the stream. I'm doing that on my phone. I'm $2 short of passing the combine. Do you think they'll pass me? I don't really trade funded accounts, so to be honest, I can't tell you. You probably have to ask someone else. I don't know Joey in real life, but he and I are good friends on Discord and from, just from talking. He's a good man. He's a very good man. Top guy. He's from Australia as well, so our language is kind of similar. Our lingo. I also ended up in profit, but I just partialed and then ended the trade in the middle because it came back just 0.01 point from my TP. Okay, so earlier I mentioned that this could be taken as a little run of stops. Has it? No, I don't think it has. Nah. That's an SMT. This is really choppy now. Oh shit, I didn't put on a risk disclaimer. Whoops. Let me find one. Right, quickly, let's just check if that's an SMT. I have an SMT indicator, but it's terrible. It's terrible. Yeah, SMT. Not a good one, but it is one. Oh my god. Who's trading YM? And if you think Nasdaq's choppy. What an eyesore. I did write a risk disclaimer yesterday. I was taking an MNQ. Really? Yes, it was. The thing is, MNQ isn't as accurate as NQ, so you go with NQ anyways. But it's interesting how sometimes MNQ just gets used as liquidity for NQ. Was there any chance to short? Like, I can't tell you that, but I wouldn't short from here, personally. MNQ liquidity fuels NQ no. Well, kinda. Yeah, Marie. So basically, NQ is like the original, and then MNQ is what follows NQ. So NQ, if I just go to this, so we have a clean chart. This is what the micro or MNQ is following. So NQ is the main one, and then MNQ is the secondary one. So everything on MNQ is going to be a little bit less accurate than everything on NQ, basically. On live streams V, this is great. Thank you, thank you. I will. SMT is arbitrary. Haven't wrapped my head around it. Yeah, to be honest, SMT, if you're on Twitter, you're going to be influenced a lot by everyone saying, oh, SMT is really good, it's the only thing that you need. ICT himself says that you don't want to be looking at SMT for trade directions, you want to be looking at it as a confluence. So if you can get a long and you're confident in your long, and you drop down below the pre-market low, and you have a fair value gap or a wonder block, that's a good setup. And then if you get an SMT on top of that, that's just an even better setup. So then you can, well, what I do is I add to my position. So say I would be planning on entering 2 contracts down here, and then I get an SMT. I would maybe add 1 contract, maybe, if I'm confident in the trade. Or I'll switch to the micro, and then I'll go in with 25 micros, because it's not quite a mini, but it is still a little bit more on my position. No problem. Choppy as fuck today. Don't touch it until the next macro, in my opinion. Yeah, I agree. And I had a trade, but I'm not in it anymore. I wouldn't be touching this with my left toe. In 1 hour, you've covered what my paid guru did in 2 years. Well, he's probably not as good as me. SMT is good confluence while trading external range liquidity, internal range liquidity method. Yeah, I agree with that. SMT is a great confluence. But that's all it is, in my opinion. I know people, and like you guys know Joey. He takes trades, I think, like just with an SMT, and it works for him, so that's fine. But in my opinion, I don't like it. I don't like it for trade direction. I like it for confluence. Just an added thing on top. What's the order block about? Is it a breaker? No, it's just an order block. OB. order block. And the plus sign, that's probably what's confusing you. Just means bullish. And then if I'm using a minus, that's bearish. If I'm using a plus, that's bullish, for future reference. How come you didn't take a trade at the fair value gap before the order block formed at 950 macro? I did, but I can't show it here because that wouldn't be very good for my legal standing. Tell you what, I'll take a screenshot and I'll put it in Discord. Belrix trades. Go. There you go. If you want to look at the Discord and check the trade, you can. It's not that interesting. I just talked through the entire thing live anyways, so you're not missing anything. But I'll send a link to the Discord. There's a link to my Discord if you want to join that. We have like 800 people in there now, or 700 people. Great learning environment. What's up? Hazards? Did you long there? I have to be so careful. I don't know what I'm allowed to say or what I'm not allowed to say. Just check the Discord if you want to see the trade. Yeah, though you didn't take it since you didn't bring it up. Okay, yeah. Over new week opening gap, event horizon, looking for daily CB quadrants. Okay. Event horizon, I assume you're looking at the new day opening gap, the new week opening gap. So Midas, hello Midas. Nice to see you. Gaming with Krishna from your Discord. Yeah, I know. You're Rick, right? Rick? Himanshu Aurora. Yeah, the video is going to be posted. If you go to my YouTube page and you click live streams, or just live, or whatever it's called, it will be the first one there after the stream's ended. It will be there. I just have some good news for you. Okay, the daily Sibi mentioned. Yeah, I went through that in my weekly outlook, but I'm not looking at it for quadrants. Streaming tomorrow? Maybe. We'll see what the feedback is like in Discord, and then if everyone's liking it, then yeah, I'll do another one. I just figure the risk disclaimer stuff out because it's probably not smart to be streaming without a risk disclaimer, especially in England. Don't see me, I'm a nice guy. I did write a risk disclaimer. Let me just find it. But I forgot to turn it into an image and just put it at the bottom of the screen. Okay, chat. Everyone's liking it. Thank you, Sui. Thanks, bro. And also, can you show us how you mark the order block? Everyone does it differently. Like some people wait for liquidity. Okay, yeah, order blocks. Don't ever listen to people who say that order blocks are like fake liquidity sweeps or whatever. And don't also, actually, we'll cover breaker blocks in a second. But order blocks, you want to go from the candle body to the body. That's if you're on a 1 minute time frame. Well, this is what I do. On the 1 minute time frame, I'm not really looking at the wick of the order block, I'm looking at the body. If I'm on a higher time frame, like the daily chart, then I am looking at the wick, because on a daily chart you're giving it more leniency and more room to react off a wick, because obviously PD arrays on the daily chart hold more significance than they do on the 1 minute chart. So if I was to mark out this as an order block, I would mark this out and I would keep the wick in mind, basically, and I would just keep checking on my daily chart. Yeah, you can go to the wick in certain situations if you have a very small body and a big wick. If I can find an example, I will use that. Okay, here we go. Say for some reason you want to use this as an order block. Would I use the body in this scenario? I would, but I would also consider the wick, because the body is so tiny that I wouldn't call it insignificant, but it's just, you want to now account for the rest of it. Go. Today was a good stream, thank you. It was the order block that closed above CE of the inverted fair value gap, a big entry signal for you. It wasn't the fact that we closed above the inversion fair value gap, although that was there. For me, it was the fact that we had price trade in with a wick into this fair value gap and then close above it. So that is always going to be a sign of speed. If you ever watch ICT's execution videos, and he'll be like, watch out for speed now, or like, I'm expecting speed, and it's usually something to do with a wick trading into a PD array and the body closing outside of the PD array. That will always, not always, but a lot of the times that's going to result in speedy price delivery, or just an increase in volatility of a couple of candles, not necessarily the session or anything. Sorry, Roxy, I didn't see your message until now. Feedback in Discord. The question is, are you enjoying it? Yeah, it was kind of fun. Okay, we're approaching event horizon of the new day opening gaps. So there's no difference in using 2 new day opening gaps, or 2 new week opening gaps, or a new day opening gap, or a new week opening gap when looking for event horizon. Great stream, you should do it every day. Thank you. So the last candle before fair value gap is the order block. In this case, yeah, but generally it doesn't matter if there's a fair value gap or not. 2-story wood filled at 550 for minis. 550, 450, 547. We haven't reached 547. I assume you mean 450. That's a really good trade. Okay, so we're getting some more displacement. It looks like we'll probably trade into the new week opening gap. I would look at this event horizon though, because of how choppy we've been. I would want to like just dial back my expectations a little bit and potentially take a partial at the event horizon. But then you do also have the low resistance liquidity, so I guess you could hold it into the new week opening gap. Do you plan to stream more often? Yeah, if people want to see more streams, then yeah. I haven't seen the photo you sent in the group yet, Krishna, on M and Q. That's still pretty good. Why do you mark out first presented fair value gap at 939 and 940? Yeah, I'll go through that again. So first presented fair value gap, there is subjectivity to the first presented fair value gap, and you can. So some people will say, oh, you don't use it if it's a balanced price range. I agree, but only certain types of balanced price ranges. And the 931 candle, I wouldn't have used this as a first presented fair value gap. And I talked through this whilst it was happening, by the way. So this is in hindsight. This was done live. This is only 2 handles wide. I don't judge off the handles, but relative to the size of the candle body, and then the candles around it, and then the wicks around it. This is really messy price action there, so I wouldn't consider this a good first presented fair value gap for me. Drink some water. So yeah, it's just really small relative to the candles around it, and then you have the same situation here. Really small gap, and I wouldn't consider it as a first presented fair value gap. Don't get me wrong, I will eyeball the level and I'll look, okay, we've reacted to that level, but I won't draw that out. And then the fair value gap I've drawn from 939 to 940. The reason being, a fair value gap isn't just a 3-candle pattern, like you'll probably get taught on everyone on the YouTube channel. Like, everyone will say, okay, this is a fair value gap, it's that 3-candle pattern. It is a fair value gap, but a fair value gap can be multiple candles, because if you understand what a fair value gap is, okay, let's look at the difference between regular price delivery. This is regular price delivery. It's back and forth until it's moved, and then a fair value gap price delivery is like that. So here we've got sell side within buy side, and then we've got a bunch of buy side, a little bit of sell side, and then a bunch of buy side. So there's not really much sell side delivery within this candle, or within this range, not necessarily a candle within the range. So there are little pockets of sell side liquidity pools that have not been filled in. Or, sorry, liquidity voids. So you've got a bunch of buy side delivery and then no sell side delivery. So that range isn't limited to just being one candle. The concept of displacing so far and overextending, like we did here, isn't limited to just 3-candle patterns, like the first candle, the second candle, third candle. It can happen across an entire range. So you can get an entire range that acts as a fair value gap. And that's what this is. This is little pockets of sell side delivery that haven't been delivered. It's just buy side. And then obviously we close past it and then we do deliver it, but we cut through candles here. I don't know if that makes sense. I tried. I've never explained that before. So if you need more on that, let me know. Brief description of bounce price range. Yep. So there are many types of bounce price ranges. Again, YouTubers will just say it's an overlapping BSC and a SIBI, like overlapping fair value gaps. That's one type of bounce price range. A bounce price range in general is back and forth price delivery within a range. So you can say on a macro perspective that from there to there is a bounce price range because it's back and forth price delivery within the same range. And there's many types of bounce price ranges. That's why I always say it's an oversimplification to call every PD array a bounce price range. You can get 2 overlapping wicks. I'm trying to find one here. It's kind of hard to find one. I'll just show it later. But you can get 2 overlapping wicks. So let's say you have a candle's wick like that, and then you have the next candle's wick like that. That would make this a bounce price range. But again, there's different types of bounce price ranges. Bounce price ranges is quite in-depth topic, and I probably couldn't cover that in a stream. I like the fair value gap paint roller analogy. Yeah, same. It did make sense. Thank you. I'm an ICT trader myself, but still going through his work. That's good. Which mentorship are you on, Andrew? Okay, the session seems to be kind of falling off a little bit now. I'm not going to be taking any more trades. But if you are, I would recommend sticking around for the 1050 to 1110 macro. and then just marking that up on your chart like this, and then just observing. You don't need to trade it, just observe how price reacts here, because we had a recent buy side delivery, and then in the 1050 macro, it's either continuation higher or retracement into a low, a swing low fold in that buy side delivery. That's the New York lunch macro, or distribution macro, or whatever you want to call it. The different macros have different characteristics. You'll get accumulation macros, distribution macros. Everyone normally thinks that there's macros between 10 minutes before the hour and after the hour. There are other macros as well, like in the pre-market model. And I'm not going to go in depth with this because I want to teach in an entire video. But you can look at 820 and 840 as potential run-on stops or an important fair value gap will form within that range. That's private content material. Okay, again, you want to be looking through the 5-minute and 15-minute for points of reference. So, wick here, and then trade just short of the upper quadrant of that wick. That's an indicator of strength in the marketplace. Thank you for what you do. May God increase you. Do wonder what drives you to help so many people. Well, I enjoy it. Thank you, Henry, by the way. I enjoy it. I like being in the Discord and helping people. That's basically it, really. And I want to have like a voice in the trading community one day. That's why I want to grow my social media accounts. W, thank you. Okay, so here again is the formation of a bull flag. So we're accumulating above an old high. So you have this swing high, and then we're looking at price action accumulate. So retail wants to see this deliver higher, and then with bull flags, you'll either like completely just stomp on them and you're accumulating, and then you'll just completely stomp them out, or you'll probably give them a fake move and then stop them out, and then go for a real move, or you'll keep dumping. There's a lot of ways for a bull flag to play out. Above average Joe. Thank you, Joey. Appreciate it, man. Yeah, I don't want to drag out the stream. There isn't that much price action to trade right now, and I won't have time to sit through the entire of the 10:50 to 11:10 macro, so I might just end it. If anyone has any burning questions they would like to ask, you can ask them here right now or in the Discord, and I'll come to that later. See how this bullish will work. Let's do this. So you could see a fake move higher of this order block, and then it's kind of hard to say if we'll trade below this or if we'll just keep going higher, because I am, on a macro perspective, I don't mean the 950 to 1010 macro or anything, I mean like on a higher time frame point of view, I am bullish. But when you're looking at the 1 minute chart, you're thinking of short-term sell stops to be raided for higher time frame buys to be delivered. So you're looking at something like this swing low. This swing low I'd say is a bit far. So you've got one swing low and your most recent swing lows here. So for lunch macro, I would like this, like right now, to trade a bit higher. And then lunch macro comes out and takes out this low. And then will it take out that low? I don't think so, because it's quite far away and we're bullish. Well, I'm bullish. So if I'm looking for a lunch setup, I'm looking for this order block to deliver us higher on a short-term basis, essentially giving us a fake move higher to please retail. They're looking at this as a buy, as a bull flag, and then they're seeing that as a buy opportunity, and then they're getting stomped out by dropping price under this low here during the 1050 to 1110 macro. My throat's getting very sore. Thank you again, Suey. Thank you for being here, man. Sell side stop's going to get cooked in lunch. I agree. I would say this low, because everyone's trailing it by now. You've had accumulation there, and then accumulation here. So impatient traders or street money are going to be wanting to trail the stops. Would you class this AM sesh as mid-price action? Yeah, I think it's reacted to key levels and PD arrays pretty well, but not at the level you want to see. Like, it's been choppy. It's delivered price in the way that you expect it to be delivered, but not with the efficiency that you would expect it to be delivered. Because sometimes, like this was good. That's what I expected from this Reaper, to trade above the order block, use the order block as support, and then keep trading higher towards the new week opening gap. But we didn't. We just hovered around it for a while. So yeah, I'd say it's mid. It's tradable though, if you were looking at the macro. If you were trading prior to the macro, I'm sorry, but I think you made a mistake. SMT with ES. Really? Oh yeah. Safe to assume better post lunch. Yeah. Unless you're looking at the 1050 macro, which, even if you're not going to trade it, I would recommend staying for the 1050 macro just to see how it forms out. This is the lunch macro, and yeah, I want to see this give us a fake buy side move and then drop down below this swing low. I'll label that as New York lunch macro expected target. It's reacted to that midpoint of the block, or the mean threshold, whatever you want to call it. It's not important as long as you're looking at the middle. So in the Discord, in the Velrix Gems channel, I always mention this one because it's so amazing. Entries. When you close at a midpoint of any PD array, or the high or the low, the next candle is very likely to be the opposite direction. So what I just said with the order block and then trading higher with a fake move and then trading below this, you can confirm that when you see price close at the midpoint for the tick of the order block. it's mid because it took me out. Or maybe you're mid at trading. Joking. So again, I would like to see this be a fake buy move, and then in the macro, trade below this most recent swing low. I want to stick around for this. Might just do it. Do you consider when price action is within a range, like today we're inside the Asian range, do you lower your risk? Nah, not really. Not really. Yeah, I'm fine trading within a range, to be honest. Okay, we've run out this relative equal highs. I would like to see this drop down now, or in about 5 minutes when the macro begins, to this low. And you leave me alone, bully. You're a bully. You were bullying me yesterday for having like 10 viewers, and now I have 35. Okay. Yeah, it's going to be a lot of waiting to do, so I'm going to end the stream, and I'm going to jump in the Discord. If you want to join the Discord, it is linked as the pinned comment, and I'll be in there answering questions, and I need some feedback on the live streams. I'll look at some trades, I'll answer student questions, I'll look through people's charts. I'll be active in the chat for about half an hour. You did bully me, Clinton. And then I'm going to go training and eat. Yeah, that's it. So thank you for joining. I hope some of you learned something. I hope you all took away at least one thing, because yeah, I think it was a good stream. Yeah, goodbye.